Good morning. This is Larry McMillan with a stock market update on Monday, January 11th, before the market opens. So we closed out the week pretty strong. All the major indices were at new all-time highs, except for the Russell, which is just off a touch, and it had a very good week prior to that. So the charts are positive and the momentum is up. As you'll see, we do have a couple of sell signals beginning to creep in here, and the market is overbought. So it's not a time for complacency, but it is still a time to be bullish. The put-call ratios are in the same state they were last week. They've begun to rise, which would be a sell signal in its own right. But the rise is coming from an extremely overbought condition. So it's more of a return to the mean, a reversion of the mean, than it is a change of sentiment. If SPX were to break down and these ratios were to accelerate to the upside, that would be a more significant sell signal. Breadth has returned to a more positive state. There were a couple of attempts at sell signals from breadth late last year, but now both our breadth oscillators are on buy signals. This morning, the S&P futures are down, I guess, like 32 points. So that's going to be, at least on the opening, some very negative breadth, and that might affect things a little bit. The cumulative breadth indicators, we look at two of those. One is the cumulative advanced decline line, and the other is cumulative volume breadth. Those are both at or near all-time highs as well. The new highs versus new lows has become literally a joke. There were 0 new lows on the New York Stock Exchange on Friday, and new highs continue to be at a very high level. So that indicator remains crazily positive, and there are some who say that when it gets this positive, it has longer-term positive implications as well. As far as volatility goes, we do have a realized volatility sell signal that occurred just last Wednesday, I believe. The realized volatility of the S&P 500 index had fallen previously to below 8% and now has climbed above 11%. That is a sell signal. Return more to that in a second. On countering that, implied volatility has given a buy signal, though. As of January 5th, we have another VIX, a spike peak buy signal. So the trend of the VIX index chart is downward, and that is generally bullish for stocks as well. The final thing we look at is the construct of the volatility derivatives, specifically the term structure of the VIX futures. And the front month, January, is trading below the second month, February, so that is also a positive indicator. Just as an aside, those February front month VIX futures don't expire this Wednesday. It'll be a week from Wednesday. So overall, except for the realized volatility sell signal and the sort of, well, weak sell signals from put-call ratios, the indicators remain bullish. So we are remaining long. We're rolling, options up to higher strikes as appropriate, raising trailing stops, but still staying long. Now, how are we handling these sell signals that are beginning to pop up? Well, what we're going to do is take a modestly negative position, and then if S&P breaks support, we'll increase those negative positions. So we're taking a small negative position based on that realized volatility sell signal. I invite you to visit our website, optionstrategist.com. I think you'll find our newsletters are very interesting, doing quite well. And in the most recent issue of the Option Strategist, we have an article about that realized volatility sell signal. So good luck and good trading.